We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is returning guest Steve St. Angelo of SRSrocco Report. How are you today, Steve?
Tom, doing great. Yeah, I think we've got, the energy is the main driver of the economy. And what we're seeing now with these energy crises around the world, there's plenty to talk about.
It's certainly right at the top of a topic of discussion in every news feed that you're seeing right now. You know, Europe, England, their gas prices are skyrocketing. And sometimes people blame inflation for it or supply chains, but you have a really interesting way of seeing all of this. So what we're going to focus today's discussion around is mainly this energy cliff and the way that this really affects and will affect going forward everything we touch, everything we have to spend money on. So why should we care about this energy cliff and why does it affect the price of everything, Steve?
Well, I call it the energy cliff, Tom, because if we go back in history and we look at the past civilizations, we find out that the growth and peak takes about 90% of the time. And then the collapse is the last 10%. So there's this idea that there's a bell curve of production of oil or coal or even population. So it's going to go up, then it's going to round off, and then it's going to be like an equal triangle. Well, if you go back in history, you look at the late Bronze Age, the ancient Roman Empire, and even the Mayan Empire, and there's many other civilizations, they just collapsed quite quickly. And there's a reason for that. It's the complexity of the system, and then it's the energy return on investment. And so what I see, once we reach this peak, this cliff, things become very volatile, and we're starting to see that. And either shortages and prices. And then what happens is you go through these gyrations of volatility. And we're not just going to have high prices. You're going to have low prices and surpluses. And then you're going to have recession. And this is going to continue for a while. And then we start really falling off with energy production. And why is that important? Because basically the assets in the world are financial assets and real estate. And those are all based upon burning more energy in the future. You have to burn more energy to keep giving those value. And so that's the problem that the market has not figured out. So this is the reason why we need to understand energy, because oil is the number one driver of GDP in the economy. And if we understand it's in trouble, then everything else gets into trouble.
Mm-hmm. So I think a really good example of this is you have a chart, maybe we can put it up in the video here, about how natural gas and coal production will actually peak as we hit peak oil as well. And that might sound, somewhat counterintuitive, but why is that, Steve? Explain that to us.
First, to make this simple for the listeners, viewers, is that if you run a car at 50 or 55 miles an hour, that's what it's kind of designed. You can run it even slower, but most people run 50, 55 miles an hour or higher. When you run a car at 50, 55 miles an hour, the tires don't warm up that much. You get good fuel mileage, and the car tends to function. Now, let's move that up to 100 miles an hour. And let's say you're allowed to do that on a highway, let's say out in Texas or somewhere. You could go 100 miles an hour until you have to pull over and get fuel. Then you get back on that interstate and you go another 100 miles an hour. And you just keep doing that as long as you can. Well, the tires are going to probably, at some point in time, they're going to blow out. And then a lot of these items that run that high are going to get into trouble. They're going to start breaking down because a system isn't designed to run at a high level. And we hit 100 million barrels a day of total oil production in 2019. The decline rate is about 5 million plus barrels a day. You've got to replace that every year, 5 million barrels a day. And it's the same thing with natural gas and coal. Why? Because people tell me, Steve, well, if we got problems with oil, we'll just move to coal. I said, well, how do you extract coal? Do you have flying cars run by free energy, or you have excavators that are run by diesel? You've got haul trucks run by diesel. Then you put that on a train and that's run by diesel, or you put it on a barge that's run by diesel, or you put it on a truck. There's a lot of trucks that haul coal, especially if you've seen that miles long Mongolian to China, I call it a train truck. hundreds and hundreds and hundreds of trucks just moving coal, all backed up, miles long. And that's all diesel. And then you can put it on a ship. So if you're going to extract coal at a high level, you need oil. And currently, it takes 1,500 truckloads just to frack one shale gas well. Well, those run on diesel. And so then you say, well, we'll just transition all this to natural gas. Well, you can't, because you're using most of that natural gas to run the electricity for the power grid. How are you going to start doing transportation? So this is the problem. When oil gets into trouble, Tom, so will coal, and so will natural gas, and so will all other energy sources. And that's one aspect that the market does not understand.
Mm-hmm. So, Steve, what considerations do we have around, like, who actually says we're going to move to coal? Because the political appetite and the environmental appetite for coal seem to be, going further and further against it. So how can that be a viable option at this point?
Well, politically, it's not, but it's funny. I put this chart out that there's, you see a lot of the climate people going after Germany because they're actually still relocating these small villages to get to the coal, the low quality lignite. And then, there's not enough being done in the United States to shut down coal plants. But the big elephant in the room is China. China produced almost 4 billion metric tons of coal and burned that. The U.S. did less than 500. So what the U.S. could do in 8 years would be what China has done in 1 year. So
and that's produced or burnt?
Both.
Okay.
They actually import a little bit as well. Mm-hmm. And so this year, people say, China's having problems with electricity generation. So they're starting to shut down some of their rolling kind of brownouts. And the problem is they say, well, they're having problems with getting coal imports. Well, they produced a record 2.1 billion tons of coal in the first half of 2021. So they're producing even more coal than ever. So I guess the issue is this. The green energy movement has forced a lot of countries to kind of shut down coal, but now we're seeing the hangover. And so now in Europe, they may have to start doing more coal burning because, when a European person is freezing in the winter because there isn't enough natural gas to run the power plant, then you're going to have to use coal, or you're going to have to make it up somehow, or you're going to have pitchforks. So these are the issues that governments are going to be dealing with as we hit this energy cliff.
Mm-hmm. Yeah, it seems much less palatable to be freezing than to burn some coal and go back on the utopian vision of green energy supplying everything. I was reading a story the other day that even as we're seeing the energy shortfall at this moment in England and the UK, that they're saying that there's a goal to be 100% renewable. I think it was by 2030 or something like that. And it just makes me wonder how, let's say, misguided that type of policy will be.
Yeah, I call ramping up green energy is pushing the world over the energy cliff quicker. Because the problem they had is that wind really underperformed in Europe. And so they had to use more natural gas. They had to use more conventional energy, fossil fuels, to make up for that loss. And then they had a very cold winter. And so you had two bad things. You had a very cold winter, and you had a warm summer, and then you had much more conventional fossil fuel energy generation, and now you're in big trouble. And so if you're going to add more of that, and that goes down, the wind stops blowing, then you've got a major problem. Because then I say, if you're going to add wind or solar to the grid, you can add a very small percentage and get away with it. But as soon as you go to 10, 15, 25, 30, 40, 50%, then it gets so intermittent and so volatile, it's a recipe for disaster. And it's just going to get worse as they ramp up more wind and solar.
So, Steve, do you think that part of that real problem with those renewable type energy systems is that we just don't have the storage in place for that yet? And once the technology catches up to being able to store it, that will alleviate some of that issue?
When you talk about storage, you're probably talking about battery. That's never going to happen. We don't have the metals and the materials to do a fraction. If we wanted to store electric with batteries, just to do 5%, we don't have enough metals and materials. We just don't. So that won't work. The other problem is, while the wind is renewable because it blows, and the sun is renewable for another billions of years because it shines, wind turbines, blades, and solar panels are not renewable. It's like anything else. After its life expectancy, you throw it away. Mm-hmm. So it's not renewable. So let's say you ramp up all this stuff. You've got 50% wind and solar. Well, as time goes on, that's got to be replaced. And if you're getting in trouble with conventional oil, natural gas, and coal that can manufacture wind and solar, let's say you want to try to recycle some of that stuff, it can't be done. It's not economic to do that. So even if you ramp up all this stuff, it's got a 20-year timeline, and then it all starts to crash because it's past its lifespan. And that's what the market doesn't realize. These wind turbines don't last 1,000 years. They last 15 years, maybe. And even the wind blades get eroded. They don't work as well. They have to be replaced. And they're massive. So this is not renewable energy. This is like a McDonald's hamburger meal that you get when you're done. You throw all the package away. Same thing. This thing, you use it, you throw it away. So if it really helped us, if it really solved the problems, I'd say go for it. But it makes the situation worse.
Because there's so much resources that need to go into trying to make this switch, right?
Yes. And again, wind and solar are fossil fuel derivatives. Mm-hmm. All right. You can't make wind and solar from wind and solar. You can't. You just can't do it. So you need the fossil fuels to make the wind and solar. Well, if oil is going to get into trouble, which it's starting to get into trouble, then there's the ability to make wind and solar or EVs really starts to tank. And I think by 2030, the global politicians, the major governments are going to, even before then, they're going to realize it's a disaster. I really do. I think we're in some serious trouble in the next 5 years. And then as time goes on, it just gets worse.
Mm-hmm. So Steve, can you give us a bit more of a perspective of if we're trying to make this switch to green energy, how much, metals that are going to go into creating these solar panels, batteries, wind turbines, how much more metal do we need at this point to be able to make that transition?
Well, I looked at a couple of studies. One looked at Minnesota and then what it would take to get Minnesota to go fully green. And I'm not talking EVs now. We're just talking wind and solar, 100%. Mm-hmm. And to multiply that by the United States, it's about 50, the population and all that. So basically, if we want the U.S. to go totally green, wind and solar, we would have to consume 50% of global copper production. Half. Right now, China consumes that. And then we would have to consume 200% of the global nickel production. That means nobody else can have the nickel, just us, 200%. And then the worst is cobalt. And we would need 2,100% of current global cobalt production, where a large percentage of cobalt production comes from the Congo. And there's a lot of child slave labor there, unfortunately. And so the thing is, there's just not enough of these metals. If we wanted to go totally green in the world by 2050, we just had to get about 5 to 10 more Earths. That's all we would need. So if we could bring 5 or 10 more Earths and bring those closer to us, then we could probably do that.
Well, we're getting pretty close to asteroid mining. What about that as a resource for more commodities like that?
Well, you see some of these science fiction movies and they have these huge spaceships. They're mining spaceships like on Aliens, and they're like a mile long. Well, just think about this. When you build something, the day you build it, that thing starts breaking down, right? The whole idea that these massive ships are going to go out and mine something, by the time that ship gets there in 30 years, you got to take it back and, it's falling apart, and so no one really thinks about that. I mean, ships and machines and plants that we have that do, the infrastructure of our economy and market, all these things break down. And you're always maintenance, right? You got maintenance guys in there constantly fixing stuff. And so when you've got a huge space mining vessel that has to go out 30 years to mine something, by the time, so the issue is that's all fantasy. Mm-hmm. We don't have the technological capability to do something that if we could do it on Earth, then we could do it in space. We can't even do it on Earth. How the heck are we going to do it in space?
So Steve, let's go back to a little bit about how the markets are going to start to react to this. Like, why do we see such massive volatility as we approach the cliff here?
Well, that comes to my analogy of running the car at 100 miles an hour. We have built up this economy to run at 100 million barrels of oil production a day. We had the pandemic shutdowns. It dropped down to 91. That's total liquids. So we're running a system at 100 miles an hour. And to continue running that, just to replace the oil, you got to use the Ghawar, which is Saudi Arabia. That's the largest oil field in the world, produced 5 million barrels a day for decades. You got to find one of those every year. Well, we've been kind of doing that for the last several decades in the U.S. shale industry that depletes at nearly 50% a year. Think about that. The average decline rate in the world is about 5 to 7%, let's say 6. The U.S. shale industry is declining at almost 50% a year. Think of the capital that you have to replace that. So we've been replacing this, but what's happened is we're running out of quality reserves to replace the declines. And that's where we're at now. So if you're at 100 million barrels a day and you're declining about 5 or 6 million barrels a day every year, that's the natural decline rate, then you have to find the world's largest oil field every year. And it's impossible. So we are consuming 4 barrels of conventional oil for every 1 barrel of conventional oil we find, and we are making it up with unconventional. And so we peaked in conventional back in 2005-06. That's why the price of oil went to 143. And now we're in the process of peaking in unconventional. And when we peak in unconventional, there's no plan B. There's no super unconventional, because that stuff has such a low energy return on investment. The world economy can't function on that. That's why we have all the debt. So this is the problem that we're facing now. It's not a matter of high oil prices, because someone says, Steve, well, what if we have a high oil price? And we could talk about that. High oil prices could make more shale profitable? No, because it makes the pipe more expensive to move the fracking sand. Everything goes up. So in time, the shale industry isn't making money because all the costs that go into making a shale well go up astronomically. So that's the issue with saying that high oil prices will bring on more production. It may in a short period, but then there's also the economy can't afford it.
So let's kind of dig into that a little bit more. You and I have spoken about the E.R.O.I. equation before, or the energy return on investment. So explain that to us a little bit more. And maybe as part of that context, explain to us something like the systems like the tar sands, shale oil, and conventional oil, how many barrels of input energy we need to extract each one of those barrels to be able to use that energy.
According to the leading minds on the study of the energy return on energy investment, and I call it E.R.O.I., like Charles Hall was one of the founders of the energy return on investment. Back during the 1930s, when we were really bringing on a lot of the California, Oklahoma, Texas oil production, this stuff, you see it in movies, the big gusher. When you hit these conventional oil wells, the pressure is so high that you don't have to do anything. The oil comes out under pressure. So back then, the energy return on investment was like 101. So 1 barrel of oil, you could get 100 barrels. And then the estimate is by 1970 in the US, this fell to 30 to 1. And even though there's different analysis on the shale oil, that's about 5 to 1, and tar sands is about 4 to 1. And the problem is, even Charles Hall said it, our modern economy needs an E.R.O.I. of oil at about a minimum of 10, but more like 12 plus. To pay for all this, you need all these profitable barrels of oil to run all the different systems in the world. Well, when you don't have those profitable barrels, then you start getting into trouble, which you start producing lower quality oil. And the only way you could do that is by adding more debt. And that's what we're seeing. We're seeing massive amount of debt, and that's the problem. So that's where we're at now. And some people say, let's go to methane hydrates off the coast. Well, that's like 1.1 to 1. Why would you even want to do that? It's not even, it's not even economic to do that at all. And so these are the problems with the falling E.R.O.I., and the Fed and central banks can't do anything to solve that.
So Steve, when we're thinking about, let's take the shale oil industry for an example, how reliant were they on debt to operate? And at what price level were they ever going to, let's say, be profitable to be extracting gas at that rate?
Well, it's very interesting. The shale industry in the United States has been very sophisticated. When it first started, you have to remember we had $100 oil from 2011, 12, and 13. It was in the middle of 14, it started to fall. So for 3.5 years, the shale industry had $100 a barrel. They didn't make any money. And so the number we hear out there's over 300 billion of debt in the shale oil industry. And some of the companies have gone into bankruptcy and their stock was like 15 cents. And now like Oasis went into bankruptcy. Now it's trading over $100 and it's a garbage company. The problem is this. When the oil price fell, they got a bit more sophisticated. Then they started doing what I call fracking on steroids. They increased the size of the lateral, went from it started about 5, 6, 7,000 feet underneath the ground. That's how long it was, about a mile and a half. Now they're doing 2 miles, 10,000 feet laterals. And not only that, they used to do 30 stages. That means they puncture the hole in 30 different places to get the oil and gas. Mm-hmm. Now it's 50 or more. So what's changed is we've gone from, basic fracking to super fracking on steroids. And for example, in the Permian, which is really the number one producer of shale oil in the United States, prior to 2015, they were shoving in about 8.5 million pounds of fracking sand. Now it's 19 million. And I even saw Exxon. They're kind of in trouble. They're not making any money with shale. They're over 20 million pounds of sand in their wells. So what that does is that give you a big boost of oil, but then the decline rate is even worse. And another problem that's happening with the shale industry is the amount of water. Before 2015, they were using about 10 million gallons of water to frack a well. Now it's over 18 million gallons. And in 2019, it was 24 million barrels of water production per day. Per day. That's the wastewater that we have to get rid of. And if you do simple math, it's almost 9 billion barrels of wastewater, 1/3 of a trillion gallons of wastewater. Less than 10% of that is recycled. It is not economic to recycle it. So what do? You see these long lines of trucks filling up wastewater, and they take it to these deep water injection facilities, and they inject it deep in the ground. And that's why we're seeing more seismic activity. We're seeing it in Oklahoma or now in the Permian. And to continue increasing oil production, you've got to go to a lot more water and sand. It's insane. We're going to try to do that. But now New Mexico, I don't need to go on here, but New Mexico, the government in New Mexico is very worried because they're the second driest state in the country. And they're using a lot of water because the Permian is in Texas and in New Mexico. So they're now starting to come down on the water consumption in the oil industry. So when you start putting all this together, basically we are devouring resources to get this oil, and it's getting worse. It's more water, it's more fracking and sand. It's thousands of miles of pipe just to get this low quality oil. At some point in time, it's not economic to do it anymore. And that's where we're heading right now.
How much of a shortfall of actual production of gas and oil are we heading into right now versus, let's say, the demand picture, Steve?
The oil situation isn't that bad due to we were 100 million barrels in 2019. It fell down to 91. And so there's still some capacity that's offline, but that's kind of problematic. But what has been bad has been really the first is the gas storage. And I just looked at the data. As of 2 days ago, the European gas storage, it was 79% of what it was the same period in 2019, not 20, because we had the pandemic shutdown. So they were able to add more gas. But 2 years ago, which was a regular year, Europe is down only 79% where it should be. Now, what happens is as the winter starts to hit, they got to burn more natural gas. So they can't store as much. They should have been storing a lot during the last several months. They will be able to add more. So right now, Europe is in trouble due to that problem. And I think I mentioned in one of my subscriber videos, there's this idea that Russia's holding back natural gas exports to Europe. That's false because Russia was worse off than Europe. They were down to 19% natural gas supplies in the first quarter of this year. So they're almost panicking. So they have to make sure that they have enough for their people So that's why we're seeing this problem. It's a global problem now. And I think we're seeing, they don't have the data out for Japan and Korea, but their natural gas prices, the LNG is in the 28, 30 range. That's how high it is.
What is it normally?
Normally it's 10 to 15.
Wow.
So now that's even double for LNG. And so this is right now, it tends to be the natural gas that's the most problematic, but in time, and it's also coal for China. And that's another issue. But right now, it's definitely the natural gas is the biggest problem. And lastly, the United States is a big producer of propane. One of the biggest producers of propane in the world. And a lot of people in the United States use propane for barbecues, for heating. Get this, U.S. propane storage levels are the lowest in 5 years at this point in time. And we are producing a record amount of propane. We are exporting more propane than we're using domestically. So unfortunately, due to free market capitalism, Americans are going to face possible shortages or higher prices of propane in the winter because the energy industry is exporting more propane overseas than it is to its domestic consumers.
Mm-hmm. Seems kind of counterintuitive at this point. But you said something at the beginning of your last answer there about oil production that is not currently online that is problematic. Why is that, Steve?
Well, from what I understand and some of the research I've done, when you pull production offline, what that does is, you see, anybody in the oil industry will tell you once you drill a well, you have to have that flow. Because if you stop flowing that well, there's problems, especially in shale wells. Mm-hmm. And this is the issue with Saudi Arabia. They do so much water injection. We're talking 6 to 7 to 8 million barrels a day of seawater to get their oil. And so when they cut production and other countries cut production, that kind of messes up the system to get back online. And so even though we have more oil that could come online, there's still that 5 to 6 million barrels a day of decline every year. Mm-hmm. So this is the issue that's just going to get worse as time goes on.
So in doing some research for today's conversation, I came across something that you were saying about inventories around the world that are being overstated. So why would you overstate your inventory versus, giving an accurate picture of what you actually have so that you know how far out you have a supply or how far out your supply is going to last?
Well, I think a perfect example is the UK. There wasn't quite the shortage of the natural gas that pushed the British people to go out and basically wipe out all the petrol in the petrol stations. It was the government coming out and saying, well, we may face energy shortages this winter. Mm-hmm. So you see, here's the problem with politicians. The politicians, I think, are going to become increasingly worthless because they really can't solve the problem. See, we're facing an energy predicament, not a problem. Problems can be solved, predicaments can't. So when you have politicians trying to solve problems, the real problem is an energy predicament they can't solve. So if they become honest with inventories or whatever, you can have fire in the theater. That's the panic. And so part of the problem that politicians now face is how to continue doing policy and running the government and trying to run the system without freaking out the public. And I think that's a major issue.
Yeah, absolutely, Steve. So let's talk about some of the broader effects of energy costs surging or energy not being available at all. So how is this going to affect the economy, metals? You have some examples of Asian countries that rely on gas for their production of goods. So give us some examples of the goods that these countries are producing that are relying on imported gas as well.
Well, there's a chart from Jankovic. He did a presentation in front of the OECD showing how the energy oil consumption matches global GDP per capita very, very well. There's a very good corollary. So basically, burning energy, whatever it is, oil, natural gas, and coal, equals goods and services. Mm-hmm. So if you have less, then you have less goods and services. That's simple financial 101. So right now, we're seeing that in these different countries, especially in China, because China is the manufacturing powerhouse, right? 50% of all the stuff that the world consumes, a lot of it comes from China. And so they're now shutting down their manufacturing facilities due to problems with power. And then there's other issues like Taiwan that has a big semiconductor. It needs a lot of water. The amount of water to make a semiconductor is astronomical because there's been a drought. You would think, well, a drought in Taiwan? Aren't they surrounded by water? That's the problem. They have a drought. And so now they have to truck water to manufacture semiconductors. So I think the issue is, again, we're at that 100 miles an hour situation, and running it is causing a lot of problems. And so the basic rule of thumb, Tom, is when we see lower energy inputs, for whatever reason, you're going to have lower goods and services. And this was interesting. Jeff Snyder, I think you've interviewed him. Mm-hmm. He said, and I got to find out if this is true. He goes, people think all those tankers, container ships off the coast of California, there's this big backlog. He says, many of those are empty because they're waiting for goods to come from the U.S., but there's no demand for those goods from the U.S. So this is part of the issue. I think there's a lot of problems that we don't realize, that the energy is just beginning to show. And so I think as time goes on, lower oil production means lower natural gas, lower coal production, as well as lower GDP. And it's going to come, I call it cliff-like declines. It'll kind of be level and then a big drop off. And then for whatever reason, could be another pandemic or just could be whatever. And then it could rise a little bit and then another big drop off. That's how the future is going to happen. That's how I see it playing out.
So how does this affect the metals like gold and silver, Steve? You and I have talked before about how you see gold and silver being, an energy equivalent store of value. So when these input costs rise to get this metal out of the ground, does that in turn mean higher gold and silver prices?
Well, it has. The 1970s oil inflation, we have to remember a barrel of oil was $1.80, went to $36. $1.80 in 1970, went to $36 in 1980. What did that do? That pushed the cost to produce metal up, gold and silver. And I looked at Homestake Mining, which was the biggest gold producer in the United States. Its cost of production exploded. And a lot of people who do these gold charts, like to look at the cup and handle formation, it's like that happened because of fundamentals. And so the oil price surge during the 70s and then the oil price surge in the 2000s was the leading factor that pushed the price of the metals higher, gold and silver. Now, that will continue. But the other aspect, when you have lower energy production, even if you have higher prices, you just can't get more production. It falls. Well, that impacts the value of financial assets, stocks, bonds, and even real estate. And that's the dynamic I see why the precious metals are going to do much better, even if the cost of production isn't rising astronomically, because they store energy value. A gold coin and a silver coin took a lot of energy to produce it. And I'm not just talking about raw energy. I'm talking about labor. I'm talking about all the capital, the machines. All that was done by energy. The materials, all the materials needed to produce these metals, that's all energy to get those materials, to make them and get them there, transport them. So when you have a gold coin and silver coin, you have stored this energy value. When you have a bond, a 10-year treasury, you need 10 years of growing economic activity to pay off that bond. So really, a bond is an energy IOU. And simply put, investors need to start moving away from energy IOU assets, stocks, bonds, and real estate. And they need to consider moving into stores of energy value, which aren't many. And gold and silver have been the 2,000 plus year stores of energy.
So how does this end up affecting the cryptos? Obviously, we've seen a massive rise in interest for people wanting these digital, quote unquote, assets. How does the energy consumption of those assets start to get affected by this as well, Steve?
Well, let's say all the Bitcoin miners were made by Captain Kirk's permission to replicate those in Star Trek replicators. So you push a button and out comes a Bitcoin miner. You take that Bitcoin miner and you add it to the 300-400 Bitcoin miners that are pumping out Bitcoins at a very slow rate. Well, unfortunately, that's not the case. A Bitcoin miner is a very complex piece of machine that has a lot of semiconductor chips that are very complex and need a very high-functioning global high-tech supply chain. And the problem is, I've done a chart, I call it the fragile nature of currencies. Well, people say Bitcoin's a currency, it's a cryptocurrency. Well, if that's the case, you got to replace that Bitcoin miner every 2 years. People don't see that. They go online, they see the cryptos are trading, and I got half a Bitcoin. Look at the price of my Bitcoin's gone up. But they don't see what it takes to run that Bitcoin system, the massive infrastructure that it takes to make a Bitcoin miner work. And you have to replace those Bitcoin miners every 2 years. And they've been doing that, but that's going to become problematic. What happens if it's like the car manufacturers can't get chips, they can't get Bitcoin miners? Well, you see, you need a Bitcoin miner to sell a Bitcoin, not just to make one. You need a Bitcoin miner to sell one. So people think, you can take a Bitcoin out of your pocket and sell it for 50 grand. No, you need a very high complex system to allow cryptos to function. And even though I see that continuing for a while, cryptocurrency like Bitcoin is running at 100 miles an hour. And I don't want to run my car at 100 miles an hour. I want to run it at actually 25 in gold and silver. That's what I want to run it, very slow and stable. And so that's the kind of analogy I look at the crypto market.
So something that I posed to Luke Groman the other day when I spoke with him was that wouldn't this, let's say, very heavy consumption of energy coin like Bitcoin, wouldn't that open up the door to something more energy efficient? Or is there more to this equation that needs to be considered, like you said, the semiconductor and replacement of the miners? So it's not just a matter of pure energy consumption. It's a matter of just overall consumption of raw materials as well, right? To run that complex system, as you pointed out.
The thing I get the most is we're going to be fine. You see, I get a lot of these, everything's going to be fine with energy. Steve, don't worry. We're just going to get these mini nuclear facilities, compact nuclear generating facilities all over the world. Well, again, Captain Kirk doesn't make those in Star Trek replicators. The components to make any complex energy facility plant, there's thousands and thousands and thousands of specialized parts that are all manufactured with materials that come from a highly complex global supply chain. Mm-hmm. When energy gets into trouble, that global supply chain breaks down. And they say, and then another thing I hear, the elite, they're going to, use technology with drones and all this and just rule all the masses. Like you do see this in some science fiction movies. Well, when energy gets into trouble, so does the high-tech drone, because it takes 55 countries just to make an iPhone. And I imagine a drone, it's probably pretty up there. When you start cutting out a few of those countries, you don't get a drone. And it's impossible to do all that in one country or in one region, one area. Just to make your own drone right there. You need slave labor almost in one of these countries to give you some of the components to make that drone. I call it the Amazon supply chain mentality. This Amazon Star Trek economy. You hit a button, you buy something on Amazon, 2 days later, it's at your front door. That's what people believe, but they don't see the complex nature of it. And another thing I failed to mention, if the Bitcoin miners have to be replaced every 2 years, the banking servers have to be replaced every 4 years. And so let's say, all right, Bitcoin gets into trouble. Well, in time, the digital banking system, now I'm online. I don't even go to the bank anymore. Why go to the bank? I just do it online. Well, that bank is run by that banking server. And that's another high complex piece of machinery that has to be replaced about every 4 years. So these are issues that we don't even think about. We just assume that they're going to continue to happen. And I think that's the problem with this mentality that we're going to plug and play something else or everything's just going to be fine. Unfortunately, it isn't.
Yeah, because like you were saying, if we were to manufacture a drone in one country, that doesn't take into account all of the resources, the raw components that have to go into that. Then, as you've pointed out before, as these systems become more and more complex, that ends up creating more and more checkpoints and supply chains that can ultimately fail and affect the ultimate production of that particular product, right?
Exactly. And, I did a study on the late Bronze Age, and there's this notion by many in the alternative media, precious metal investors as well, community that, the elite, there's a lot of analysts in our community that are always going after the boogeyman, the elite. No, there's always been elite. I don't care if you're a serf during the Middle Ages or in the ancient Roman Empire or the Egyptian Empire. There's always elite. They're always going to be there. But here's the thing. When you hit the falling energy return on investment, the elite go down And during the late Bronze Age, one of the more famous archaeologists said that the elite, they were destroyed. And that's where most of the wealth is. Well, if you're going to have problems with energy, those who have most of the wealth are going to get into serious trouble. So this idea that the elite are going to kind of like buy up all this cheap stuff, why? It's not going to function. It's going to be very disruptive. So for all those who can't sleep at night because they're worried about the elite taking more, control of us, they're going to get into serious trouble. People have to kind of ignore politicians and the elite, and they're going to have to start focusing on what they can do for themselves, their family, and their local area. That's where we have to refocus. And, I hope we talk about LNG, because if the epitome of the semiconductor for technology, LNG is the epitome of high complex. And by us ramping up LNG, we're at the end of this civilization. And it's just amazing when you start looking at LNG. I call it a white elephant.
Because that is the marker of, the ultimate in complex systems to get energy transferred to other parts of the world.
Bingo. You see, the U.S. uses natural gas. Why? Because we're a big producer. Japan does not use natural gas. It uses LNG. It does not have any natural gas fields really remaining. So it has to import natural gas. Well, it's kind of impossible or uneconomic to have a pipeline from the United States going to Japan. So you have to make LNG, liquid natural gas. And let me tell you, the LNG processing export facilities, they start at 7 billion. They go up to 30 billion. And what happened this year in April, there was the Islamic insurgents attacked the LNG facility in Mozambique, the Total, and they went into force majeure. It's a $20 billion LNG facility. They're not going forward with it right now. And they don't even know if they're going to go forward with it. And so when you have the processing plant and the export facility between 7 and 30 billion, then you have the LNG carriers, and the ones that they're building now are $250 million, 250 million a pop. And then you have to have the LNG import facility that's between 1 to 2 billion. And all they're doing is taking this natural gas, making it LNG, and then shipping it. And then they have to make it back into natural gas. And then they have to, it's talk about destroying the falling energy return on investment. And just for a sake of comparison, a brand new super tanker, the big ones are 120 million. So you need to do a typical LNG export facility that they call it about 5 million tons a year of LNG. You need at least 4 to 6 LNG carriers. Well, you could get 2 super tankers moving oil for 1 LNG carrier. It just goes to show you how expensive we are trying to continue business as usual by supplying more energy farther away. And so we have destroyed the value of that natural gas with LNG. And unfortunately, I've got a report here that shows, I just want to read this. Of the 38% of the facilities that are going into production, they're in serious trouble of construction, LNG. There's so many problems now with the force majeure of that Mozambique LNG facility. There's problem now. People are concerned because it takes so much upfront capital. And then the prices of LNG are very volatile. You don't want to, invest 20 billion. And then you find out that the price of natural gas or LNG could go up and then it could crash. You can't do that. You can't invest into something that's very volatile. So these LNG facilities that are being built are in serious cost overruns. There's outages rates in the facilities. And so it is energy production, transportation on steroids that is too complex and too expensive. And it just is it just epitomizes us the peak and collapse of our high-tech energy system, LNG.
Interesting. So, Steve, what do we do? What is the solution? How do we, let's say, make money up to that point? Do we invest in energy companies? Do we invest in metals? How do you see let's say, the financial solution, as well as, is there any types of technology out there that you think can help, delay this crash from the cliff?
There is some technology out there. I've spoken with Louis Arnault. He's got this Engenie. What it does is it tries, you see, what's the problem is 80% of the energy we burn 85% is wasted. All the oil, natural gas, and coal. It's lost in transmission lines. It's just lost. We're not efficient with it. So he suggests if we can get really efficient with it, we don't need as much of it. And what we have, we could use more. And then he's got a system to capture some carbon, with climate change. But the problem is, I don't see that happening because the system is now, it's kind of like a snowball going down. It's an avalanche. It's getting worse and worse. I don't see enough inertia to make that work. And it's just too problematic. So unfortunately, the best thing we can do is a managed degrowth. The only option we have is to be honest. And after everybody panics for a little while, okay, we're gonna do a managed degrowth, and this is what we're going to do with the energy we have in a smart way. But I don't think politicians are gonna do that. So there is no solution to an energy predicament. So the only way to deal with it is to be honest about it and have a managed degrowth. We're not going to do that. So I imagine we're going to continue to ramp up green energy. It's going to make things even worse. And we're going to go over the energy cliff and collapse, unfortunately, just like every other civilization in the past. Most of them collapse due to the falling energy return on investment. And it's no different today.
So what becomes, let's say, a safe investment in that scenario, Steve?
We still have to live somewhere, and there's still going to be business. I would say, I think the biggest centers of business in residential areas, big cities, I think they're going to be in big trouble. And so I think the issue is people are going to start we saw that with the pandemic, right? They start shutting down the big cities and people say, well, the heck with this. I'm getting out. I don't want to be forced not to go anywhere. So people have been already moving out to the suburbs and to the country. But I think we're going to see people move more. The exodus is going to be to the country. And so I think what people need to be doing is the precious metals to me are keep it simple, stupid. And, I continue to get people to ask me what are good investments. Well, I think, some energy stocks are probably going to do well if they can keep production. If the price of oil keeps going up higher or, corrects and it keeps high, then yeah, the stock prices are going to go up for a while. But also, when you have shutdowns, look what happened to the energy stocks. They crashed last year. So it's going to be very volatile. So to me, I think the safe havens are the metals. People need to own homes that are more out in the country. And they need to grow more of their own food. They just need to be more in tune with the local area and local energy sources that are more sustainable. And I think people need to move away from that, which is more supply to them, that they're more dependent upon, independent of energy sources as time goes by. And so I think what's happening in the UK is going to happen in the United States with blackouts and brownouts. That's coming. I'm not saying it's coming anytime soon, but I was actually surprised. I didn't think we were going to hit this energy cliff. We've hit the first symptom of it. But then the other side of the shortage is falling prices and then a surplus. That's the other cycle. And then that's kind of a recession, but then it's going to be a spikes again. And then as we get in this peak area for the next several years, once we start moving down oil production, that's when you start seeing rapid disruptions in the global supply chain and the value of assets. That's how I kind of see it playing out. I hope it didn't go on too long, but that's kind of how I see it playing out.
No, absolutely. It's an interesting perspective to try to understand. As you say, we'll have rising oil prices, which will contribute to the factors coming into, let's say, a deflationary environment, if I understand you right. And then, that will be the other side of kind of the more dramatic crash, right?
Yeah, it's like when we had the 1970s oil inflation, we had the hangover in the early 80s. Oil production and consumption fell in the 80s, and the world had a recession. But in the 80s, we still had 4 decades of growing oil production. See, I've got this wonderful chart, Tom. It's always been about the oil. People talk about, World War II, the Depression. Roosevelt got the U.S. out of depression. And some people say, no, it wasn't Roosevelt's New Deal that got the U.S. out of depression. It was World War II because we helped the Allies win the war. And that's false because we were producing in 1941, 70% of all the oil in the world. People don't realize that. The United States in 1940 was producing 70%. We were the Saudi Arabia. Saudi Arabia never produced that much of a percentage of global oil production. So it was the oil production growth that got the U.S. out of the Depression and was able to allow the U.S. to be the manufacturing hub in the military, to supply all the military, the ships and the tanks and even the oil, the energy. That's what won the war, was the energy from the United States. Same thing happened in the 2008 financial crisis. It wasn't the Fed's QE policy. It was the 8.5 million barrels a day of shale oil production growth that pulled the U.S. and global economy out of the recession. So people need to understand it's always been the energy. Always, always, always.
Excellent, Steve. Do you have anything else that maybe we didn't touch on before we wrap up here?
I wanted to kind of relate this to the ancient Roman Empire, which we hear a lot of reasons the ancient Roman Empire fell. And I kind of, I always knew it was the falling energy return on investment, but until I started doing research on the wood, how much wood it took, and basically these early civilizations, the Bronze Age and the early Iron Age and the ancient Roman Empire, during the peak of the Roman Empire, to produce silver, they cut down 100 million metric tons of wood to produce about 10,000 metric tons of silver. And this is during their peak. Well, I estimate in the whole Roman Empire, if we include iron production, copper production, gold production, massive amount of trees to make charcoal to smelt these metals, and then the ships they made, and then the military, they used the wood, the construction, we're talking 1 billion trees. And so the reason why they went into the Germanic area wasn't because they were bored. They needed wood. Same thing with the late Bronze Age. So the collapse of the Roman Empire wasn't the debasement of the denarius. That's the symptom. They peaked in silver production. So if you peak in silver production because you peaked in your wood fuel energy return on investment, they didn't run out of silver ore, they ran out of wood. So their production of silver fell. So to maintain their system, this huge Roman Empire, they had to debase the silver denarius. And that's the thing that a lot of people don't understand. It always comes down to the energy first. Everything is a symptom of the energy. And so I just wanted to share that because I actually had no idea until recently how much wood was consumed during these ancient civilizations.
And that goes back to your point of, these systems becoming more and more complex and then eventually just collapsing in on themselves, partially due to the complexity and partially due to their energy demands, right?
Right. And, the reason why the UK was a world power in the 1800s, even though it lost the US in the Revolutionary War, was it had a 50-year technological advancement on how to use coal to smelt iron than wood. And that was a big change because we were using wood up until the 1700s and early 18 to smelt iron. And they figured out how to use coal. And then coal became the number one. Look how much, a lot of that coal that China produces, that's to make steel. As well as, it takes a lot to make steel, iron. And so it's the same thing. And so they went into the coal, and then we went into oil and then natural gas, and there is no alternative. So you're exactly correct. There is no, when someone says, well, Steve, don't worry, we'll have technology fix the problem. No, it isn't. Technology is the problem. More advanced technology just consumes more energy. So you can't solve a technology problem with more technology. You need more energy. And if the energy is the problem, then technology is the problem. So I wanted to end it there.
Yeah, absolutely. Like you say, a technology problem can't be solved without more energy.
And what I get is I have debates on Twitter, and I think you probably see some of my tweets. People think that the semiconductor is more efficient. It isn't. It isn't, because they fail to consider the decades of engineering capability that took all this energy of all these students that became engineers and all the colleges to run these schools, and then the massive supply chain it takes to make a semiconductor and these massive fabs. You should see, they have their own gas bulk facility. It takes specialized gases. They have like their own energy system, their own refinery, gas refinery, right next to each fab plant. And you look at these things, the pipes, it's so complex. It's not more efficient. It's less efficient. It just looks efficient because due to the complex supply chain, we don't see it. We don't see all the complexity. So because maybe the chip is lower in price, we don't see all the complexity that goes into making that chip. So actually, the more high-tech the chip, the more complex the chip, the more energy it's consuming on a massive scale globally. And we just don't understand that.
Mm-hmm. We need to look at the whole picture, not just the actual chip itself and what goes into running it, more to produce it, right?
Yeah, that is correct. It's the entire supply chain, Tom. And unfortunately, as I've mentioned, the Amazon Star Trek replicator economy, that's what it is. Mm-hmm. I hear it all the time. People buy on Amazon and it's on their door in 2 days. And so if you're just a person that's got a typical job, wherever it is, you have no idea what that supply chain is. So if you think, well, chips are just more efficient, you're going to believe it. And even some very intelligent people say that. I'm actually quite surprised.
Mm-hmm. Well, we appreciate the deep dive here, Steve. Of course, you have much more resources available on your website at SRSroccoreport.com. And your Twitter is a great place to get more information as well at SRSrocco Report. Steve, thanks so much for your time and your perspective today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.